right, mic check. Mic check. Let me put this on Twitter. Cool. Pop this out. Cool. All right. Ooh, forgive me. I'm still a little bit under the weather. Just slightly recovering. I actually need to take more Dayquil right now. But yeah, so we're just gonna go over Bitcoin real quick. I actually created like an agenda, a docket, if you will, a list of things to talk about. Because usually I just ramble, and you kind of get to see how I look at a chart, and how I look at TA, just like live and on the spot, which I guess is the point. But at the same time, I feel like this will be better, more constructive for both you all, and really for me. I always tell y'all the live streams are for me, because when I live stream, I'm really just trying to go over principles that I trade on, and do analysis that I like to do, and that like explaining it is a really good way of learning it yourself. All right, it's like, oh, and if you ever see my screen kind of like start shaking and it's real fuzzy, or not fuzzy, but it's just like it just kind of spazzes. That's me like shifting windows, but y'all can't see it. All right. So first, what I want to do, I want to look at the weekly chart, because the weekly candle had just printed yesterday. As you see, we've already taken out the previous weekly high, which we actually formed towards the end of last week. And the reason I want to point out this weekly view, for two reasons. One, so just to reinforce that this is the bearish order block that we are at. This is where price traded into, was dumping, and then it kind of stopped. And then this is where some brief consolidation happened, a pullback. The bulls took back some of this move before the dumping continued. And as you can see, that's what we've traded into, and that's where we kind of stopped at. I guess by that same token, I also want to point out, I don't know if you will call this an order block. I guess you could if you wanted to. It's basically a down candle before an up move. And it served as some level of support multiple times. As you can see, we've come into it, let's see, 1, 2, 3 times and popped out. And if you want to look at the closes of the candle, each one of those tests has been, lower. So that's noticeable. But that's not really what I wanted to show. Really wanted to show this right here. And so then if we go into the daily, you see we've actually kind of peaked above the top of it. Not peaked as in like a high peak, but peak is in like, I don't know, like looking, like we've kind of looked over the top of this block. And if you want to take a dashed line, this is where a lot of people are looking for maybe like a stop run type of scenario where we trade above this line, but then ultimately close above it. And many people will infer that to mean that the market traded up here, took out people who were short, but had stops above this high, because traders like to put their stops above obvious highs. Let's see. Oops. Right? Take out stops above that high, only for us to go down and continue lower, or some type of scenario like that. So right now we're really kind of like battling with that region, with that zone. And so that's something to keep your eye on. Remember this red block, this red rectangle is our weekly order block. Um, let's see. Looking for a stop run here. Yeah, that's about it. So next thing I want to show you all is this wedge. Now, this is how I will draw a wedge. This would make sense to me. First, I'll go and change price from candlesticks to a line, right? And then I'll double click in here, or I'll click on the settings, doesn't matter. But I usually double click on the line. And then you can see the source of the price, the thing that you see. The line is painting every candle close. And so what I will do when I want to draw like a really accurate pattern, I'll pick the high and the lows depending on what pattern I'm trying to draw. So for this wedge, I'm going to pick the highs. So now every time it paints on the line, it's painting the highs. And so if I want to paint a wedge, I'm going to pick a high that I care about, maybe like this one. I'm just going to try and connect as many of those highs as I can. I'm just trying to cut through as many as possible, get as many points of contact as I can. So I got one, you know, here, 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 here. Couldn't quite touch here. That's fine. And then got some of these highs. And then what I'll do is go down and get the lows of the candle. So you can see this line isn't even touching the price line anymore. And that's because this was drawn based on the highs, and now we're looking at the lows. And so I'll start here and then maybe draw as best as I can. It's a pretty tight wedge, so you'll see it when we're done. But yeah, maybe I'll pull it out just for aesthetic's sake, but you could totally just like stop here or like here just to show that there is this gap right here. And then once I'm done there, then I'll just pull it out now that I have my boundaries defined. And then from there, I'll turn the line off and go back to candlesticks. And then that's how I'll get my wedge. And so I do want to acknowledge that price is in this sort of wedge where we have this wide base right here, and we're getting narrower and narrower as we go up. And we're really towards like the top of this wedge. If you want to draw these as rays, let's see what happens. You draw these as rays, then this is for sure the peak right here. That just isn't aesthetically appealing to me, so I usually keep those off. But I did want to point out this wedge. I think this is important to understand because we're at a wedge right at a resistance level. And so we would expect a scenario where I'm not saying the sell-off would be this dramatic, but we would be expecting some type of sell-off. Now, taking the target is weird because of the nature of how tight this wedge is. But for me personally, I know for sure that this is going to be like, this area is going to be the bottom of where I take my measurement. And you could take the top of it to be here. It could be here. So, I mean, just depends. I think it'll make sense to take it from here down and try and line it up over here. And get a little approximate range. And if we do that and take that up here, it depends where it breaks down just because it hasn't broken down. But I like this because, and I'll remove that just so you can see. We basically took the distance, the vertical distance from here to here, and then dragged that up here to where, you know, the top of the wedge where we might expect a breakdown. And I like that because right here it kind of lines up with that support. So we might expect this level to act as support again. So we might look for a sell-off, and if we were looking to take targets, or if we're even looking for like a long entry in the event that there is a sell-off, then we would probably be trying to do that here. And if you looked at previous videos, you understand that I'm very hesitant about being bullish in a scenario where we retrace back to this level of support. Right? Just because, let me make that like black or something. Just to this level of support, where it was a previous resistance and we're expecting it to act as support, we might be hesitant in that situation just because that would involve us shooting this low volume node. Again, if you've seen previous videos, just bear with me. I think this is very important to understand where my thought process comes from. Low volume nodes, if you don't know, are essentially like Wick City, or a place where price will react very violently, where we'll dip into the low volume node but immediately just leave, similar to this, or we'll shoot through it immediately, kind of like this, where we basically accelerate it towards the low volume node, took a brief like stutter step, think of it like somebody running, and then boom, we smash right through it here, or we just smash through it going back up. The point is, price does not spend a lot of time in low volume nodes, as you can see. The movements are usually very violent, and if there is a return to it, you're usually going to get wicks of some sort. And so I'm very doubtful of a retrace back to previous resistance turn support because of that low volume node. But in the event that we do retrace back to about 6.8, I highly doubt that we return back up and make new highs. And that's just my thought process behind that and why. None of this is law. None of this is the gospel. Price and the market can literally do whatever it wants. Technical analysis can literally be any story that you want to create, bullish, bearish, or neutral. It's just about figuring out which story you think makes the most sense, given the circumstances for price and the overall market. But yeah, seeing this wedge, I'm expecting a target of at least around here. Let me go to the daily, just so maybe I can make this a little more clear. Yeah, so expecting like a wedge target over here, wedge target. I think this makes a lot of sense. Let's see, other things I think will be useful. Divergence on volume I think is important. So I'll show normal volume, and you can see the div here. We'll put it in a dark blue. You can see price is increasing. We're making higher highs on less volume. That's concerning. In addition, the only spike in volume we got in between these lower highs was some bearish down volume. A lot of selling happened on this candle. But the on balance volume oscillator does a really good job of letting you know where that divergence is, because you totally can see it just using normal volume. That's all that this is deriving its calculations from anyway. The on balance volume, which is a derivation of the on balance of volume itself. But Lazy Bear's on balance volume script indicator on TradingView does a better job of helping you visualize it. But I just want to point that out because it's not like some subjective magic. Like, it's totally the same numbers used in on balance volume, which derives the way that's viewed and calculated from these volume bars you see down here. No different. So But this is important. Higher highs on less volume is not good. I'm not going to sit here and attempt to draw these divergences. You totally could if you wanted to. But these would be very low probability divergences just because, and this is why I keep this type of data on my lines. You can see it 34 bars. RSI is calculated using 14. You go to any of your settings, you'll probably see the length 14. The ultimate oscillator is used with like an aggregate set of calculations using a length of 7, 14, and 28. But the point is, if you have a line that's 35, that's much longer than what these oscillators are calculating. And so even for on balance volume, for 20, 35 is too long. So what you would want to do so the point that is that they're still valid, quote unquote, if you want them to be valid. I mean, you can draw whatever you want, but they're definitely not how divergences were intended to be used. Because you could imagine somebody drawing a divergence across the chart on like a 5-minute time frame, saying, "Oh, look at this," when that's just simply not the case. And so it'll lower your probability if you're basing trade entries, exits, whatever, stops based on those things. So what you want to do is go to a higher time frame where the period is lower, and see if those divergences, still exist. So let's go to the 6 hour actually, which is just a quarter day, and you see this 26 bars. We might still accept that just because the ultimate oscillator uses a period of 28, and so you do see that type of divergence. You're not quite seeing it on the volume. It's there slightly, but hasn't finished to really show itself. So I don't know if you would really want to consider that. And so then from there, you're like, okay, I'm still really not convinced on this divergence. I feel like I'm forcing it. I mean, go up. 12 hour. You see something similar. And let's use the B band %B. That's also a pretty good indicator for divs. You generally want to use multiple oscillators when trying to find divergences, because sometimes you'll see a div on one oscillator and it won't exist anywhere else. And so then you want to ask yourself, okay, how valid is this? And sometimes that oscillator may give you the key where the other ones didn't. So it just depends. So for here, that's another thing, very important. Make sure when you're doing this, your source is the close, because same thing with like the periods. These oscillators are calculated using, let me see, the candle closes. So here, the source is the close. Here, the source is the close. So if you want to find divergences using the open highs, lows, whatever, you're going to have to switch your oscillator calculations to that. So don't get in a situation where you're drawing from like wicks up here on price, and trying to compare that to the oscillators, because the oscillators are not looking at the highs and the lows, which are the wicks. So yeah, make sure you're looking at the closes. So here again, we see we're making higher highs. Our oscillators are making lower lows. You can see we're only having 12 bars, which is very interesting which is very good because RSI is only using a period of 14. The B band %B uses a period of 20, so 12 is well within that range for a div. And then here. So this is all speculation because as you see, we're still on a green candle. We're still going up. There's nothing to say that we can't literally do one of these maneuvers right here and completely blast off. These divergences are something I just want to show you to keep these in mind, because if price does stall, or we do a small retrace right here, then you want to make sure that you have these divergences in mind to know, okay, this isn't just a small retrace. This is an overextension by price. This is the oscillators letting us know the trend should go downwards for a little bit, and that there's weakening in the up move. So something to take in note or keep in mind, keep note of. Yeah, that might be it for that. The only thing that might be useful to look at would be the stochastic RSI. Stochastic RSI and the Awesome Oscillator. These are decent for divs too. But they show up, like, they're not going to show up as rampant as they are on other oscillators, which is kind of why I also like them too. Because if you do see a div on stochastic RSI or the Awesome Oscillator, then you should probably, give a little more attention, because divs just don't pop up everywhere. Like, here was a good example of a div on the daily time frame where we made this lower low, but the Awesome Oscillator made this higher low. One moment. Ooh, excuse me. Told you I'm still recovering. And same thing with stochastic RSI here. So this was a great time to understand the trend might be changing a little bit. And as you can see, we really took off from here. And then once we made this divergence on the stochastic RSI, you saw that we made a hidden bullish divergence after the normal bullish. And so this was very good for just daily time frames. Easy trading. So kind of the same thing we want to look at here, to see if there's anything over here we might care about. So don't see anything on the daily. For real. I'm going to go down to the 12-hour. Higher high here, and a higher high on price. That makes sense. Cool. 4-hour divs. Oh, I have a lot of lines drawn. Not sure you really want to consider that, again, because the bars, 33 bars, but stochastic RSI is calculated using periods of 3 and 14 for the fast and the slow, or the slow and the fast, whatever. So you may not want to weight that. And then when you start trying to fit it into the 6-hour and the 8-hour, you start getting a little funky with it. I'm not sure you really want to trust that type of analysis, but if it floats your boat, go ahead and do it. Don't really see it. The only place we see it develop is on the 4-hour, and then it's not valid because the divergence is too long. But we'll see. So zoom in on the 1-hour real quick. Got this flat top. Oscillator is moving down as the top is flat. This oscillator is moving down as the top is flat. Let me look at this oscillator. Yeah, it looks like this in particular looks like an exaggerated bearish divergence, where you have this flat top with the top on the oscillator sloping down. That's short-term bearish since it's on the 1-hour, but we'll see. And that's pretty much that on that. Just want to keep a lookout to see if these divergences propagate out to higher time frames in which the length wouldn't be so long on them, and they might become more valid for us to use. Yeah. So we might want to look on the 6 hour and see if there's a div that ends up forming here or here. But that's that. The next thing I want to show you all were Wyckoff scenarios. And there's two. So this is the bullish scenario, where if you type this in, Wyckoff accumulation schematic. Oops. Let me see if this pops up. Yeah. So where you have something like this, reaccumulation will not have the same phase A. Reaccumulation will have a phase A that looks like distribution, but then the rest of it will look like accumulation. And if you're not familiar with Wyckoff logic, please look that up. I don't really want to. There's plenty of videos to explain that. This is not one of them. But if you are familiar and you're understanding this, then essentially this is like the bullish case, the accumulation case, where you have a low volume spring, which essentially means this downward movement isn't being supported by the market. People aren't actually selling, and as a result, we pop back up into the trading range. Usually that pop up should occur on high volume, which we don't see. But this part of the dump occurred on low volume, which is important. But don't let that take away from the fact that this movement down here occurred on pretty decent volume for the range. Had a small test, which actually should have that labeled. The test is essentially once we've had the spring, we try and return back below the trading range and we fail. And then we end up going back up. Last point of support, where we get more buyers step in at a higher range, and then this would be viewed as breakout volume, where we break above the trading range. This was the highest close. This candle right here, this was the highest close for this whole range above resistance. And pullbacks can either be very like sneaky like this, to where price will try and come down, but there's so much demand and so many buyers at this level that the wick just gets eaten up. Or that's why the question mark, we might still be waiting on some sort of retrace back down here before we continue upward. So that's just one scenario, and that's kind of like the bullish scenario. The bearish scenario for distribution would be this one, where we're looking more like this schematic, both phases A, B, C, D, and E, where we're coming up, all the buying is exhausted, we go sideways for a moment. This was an upthrust where this caught a whole bunch of longs. People thought they were being breakout traders, but didn't wait for confirmation. Wicked above resistance, but closed well below it. Super long upper wick. Volume shows that most of the volume happened on the selling. And then we come down here on decent volume. This was a sign of weakness if you want to consider this top line the bottom of the trading range. And if you extend it, can you extend? I don't know if you can, but let me go to the line tool. If you would extend it to the left and you consider this to be the bottom of the trading range, then a lot of this trading down here was a sign of weakness. It showed that the market was okay with lower prices. There was not demand here at the bottom of the trading range. Buyers did not step in. And this volume shows that there were many people willing to sell up here, which is important. And now we're up here, and you would possibly consider these wicks right here to be some distribution occurring, to where the market is trying to really get every ounce it can out of the buyers, trying to trap people in longs. with very mediocre volume for a breakout. And really, this is distribution, or this is the upthrust after distribution, where the sellers can really do a lot of their selling at premium prices before taking us back down and buying again from the people that sold, from buying again from the people they sold to up here. So if that makes sense to you, great. If it doesn't, think of it like I sold you something for $10, and then I took price down and bought it back from you for $1, right? So you get screwed in that scenario, right? Because you paid $10 for something, and then when you tried to resell it, you got a tenth of the price. But I win in this scenario because I sold you something for $10, and then I was able to get it back from you at a fraction of the price that I sold it to you for. And that's really all markets are doing over and over and over and over and over again. Market makers, smart money, institutional investors, whatever you want to call them, they're basically selling to you at premium prices or retail prices, whatever, and buying from you at wholesale prices. That's literally all it is. They want to buy low, sell high. And so if you're under that bias, you would be looking at this like, okay, volume is really kind of like shitty here. We broke out. We should be, super bullish right here, but we're kind of not. We're kind of, fucking around. This would be distribution, and you would expect some type of maneuver that looks like down, maybe a retest of up here and then down. Some bullshit right here in purple, and then take us lower, right? That would be that version of events. Can't really tell right now. If you do want to go long, the smart scenario is to go long here. You want to try and buy at a retest of resistance as support and put your stop somewhere under either the last point of support, because if that really was the last point of support, then there shouldn't be any more buying happening down here, right? Price shouldn't trade this low. But even then, if you see that, that's a really tight stop. Not sure. But that's just what makes sense. And of course you can like zoom into lower time frames if you really want to put a stop somewhere tighter. If you want to enter a short position, now would not be the time. The time would be to wait for a break of that level right here. You want to wait for a break of resistance, a confirmed break, not like this shit right here, a very strong break, kind of like this candle on very solid volume. And then you're going to wait for a retest, and then that's where you short. If you do want to enter a short position now, you would enter a partial position, maybe 1/3 of your position. And then you would look for some type of last point of supply for a retrace, and then maybe add more here, wait for the break, and then add the rest of your position here, and then ride the rest out. But just know any short right here would be an aggressive entry, especially considering how bullish things have been. Cool. Last thing, I guess, that would be good to look at. The 200 daily EMA, which a lot of people like to look at as traders, is right above price right now. We're pretty much facing off with it currently. Haven't touched it, but don't be surprised if we get a good little wick here, only to reject it and go down. Maybe not that viciously, but something like that. but we are definitely about facing a major resistance. So a flip of the 200 daily EMA from resistance to support would be good for bulls, because many traders look at this as a dynamic support and resistance. We've been below it pretty much ever since that initial dump from 10K, 9.9K. And this is our first time retracing back to it. And it may even be a scenario where we reject it initially, come up, break it, turn into support, and then keep going. So just wanted to put this on y'all's radars. Important thing to watch. On the 4 hour, we're below it. If you're wondering what these other two EMAs are, they're the 12 and 26 EMAs. I find them to be extremely useful. Feel free to use them as well. As a dynamic support, you can see if you went long off of the touches here, in between here in this zone, would have been very profitable. Let's see. Oh, and we're at the resistance of the 12 and 26 EMAs on the weekly time frame. So again, if you went long off of these EMAs here, 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 or here on the run up, would have been great. But now it looks like they might be turning into some type of resistance. So something to keep note of. And that's pretty much it. I did want to go over the Ichimoku cloud, but I'm not sure I really want to anymore. I'm not sure how useful that would be. We'll do it real quick, I suppose. Let's see. Where is the Ichimoku cloud? Oh, I can't see. Here. Oh, no, that's the wrong way. They got me clicking on the wrong shit. Boom. Okay. Ichimoku cloud. On the daily, we've initiated an end-to-end trade in which your target would be either here at about 9K or here at about 7.86K. You would be aiming for the flat tops or the other side of the range. We were initially facing cloud resistance, but ended up closing inside the cloud. So this would be a bullish entry signal with your stop way below the Kijun. So, I mean, that's not a great R&R, but by the cloud standards, you most definitely would be having a 12% stop with a target, you know, possibly of about 2% out, or maybe even 13% for like a 1 R&R. Not the greatest thing, but it is what it is. Lagging span over price, which is good, but it's below cloud, which is bad. Bear cloud, no green twist in sight, not bullish for the future. TK lines cross bullish, but under the cloud, which is not the greatest. 12-hour cloud. Almost looks like you have some type of pivot high forming here. Not quite a pin bar, but looks like it could be one on the candlesticks. But as far as the cloud's concerned, had a bullish cross. Price does look to be well above the Tenkan and the Kijun line. Not forming a C clamp, so it doesn't necessarily mean oversold or overbought, excuse me, but might be a little too far from the Tenkan or the Kijun for comfort. Lagging span above price, which is great, but inside the cloud, which is like, not bullish. Bullish Kumo twist in the future. We completed an end-to-end trade, which is good. If you took this on the 12-hour, you pretty much took no pain. Entered right here. Stop under the Kijun. And at this point, your stop would be in profit if you hadn't already taken profits up here, which you should. And then you would expect the cloud to turn into some type of dynamic support for you in the future. But yeah, that's pretty much it. I'm sure the 4-hour cloud looks super bullish. Yeah, it looks super bullish and super overbought. So yeah, that's pretty much it. Pretty much all I have. So hope you all learned something. And I'll see you all later.